India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's looking better. It is looking much better. And we'll tell you why over the next 1 hour or so right into market opening. I'm Prashant. With me, my colleagues Nigel and Sonia. Guys, hi, good morning.
Hi, good morning. Anything can look better than what we saw yesterday, right? I mean, and of course, everyone's hoping that the dips get bought. But let's see. We have a long day ahead. But the good part is there's a gap up opening expected.
Well, that's right. And we'll need to build on from there, which will be very, very important. And a big day coming up for the markets. And later tonight, a big day as well for the Olympics when India plays that crucial semi-final.
Okay, absolutely. And I think let today in the market also be a bit of a semi-final.
Big day.
Because, you know, absolutely. So let's rewind the clock back as we always do and tell you what you need to know as we begin another session, right? What was the big worry on Friday and which kind of triggered all this mayhem and sell-off in the US and then in Asia yesterday? It was the jobs number, the labor market data, which had weakened so much. So I want to start with a data point which is right in the opposite direction of that data point. And this is the ISM Services Index, which is now rebounded in the month of July to 51.4. This is strong data as opposed to the weak labor market data. You know, if you look at this, all subcomponents expanded. And you also had the employment index within the ISM Services Index, which actually rose, which expanded. This is in contrast to the labor market data, which spooked markets, sort of sparked off recessionary fears, etc., etc., etc. And I think that is basically something which provided a sigh of relief for markets. Remember, in the US, it's not a data-heavy week. So this is one of the few data points which we are going to get. And this came like this. Remember, services is about 55-60% of the US economy. It's much more stickier as compared to manufacturing. And this number shows that you know the economy is fine. I mean, it's not showing any recessionary trends. Now, and price action reflected in this as well. I'll get to the price action in just a bit. But one more thing, you also had the Chicago Fed president who was interviewed on CNBC. We'll play out the sound bites in a bit. And he said he kind of did not rule out any emergency rate cuts and emergency measures. But he said it doesn't look like the U.S. economy is in a recession. But he also assured that if the economy deteriorates, Fed will, and I quote, fix it. Now, we've seen the Fed trying to fix the economy many times in the past. Not the economy, but the markets more so. Last, of course, was trillions being printed during the COVID emergency, and before that, during the global financial crisis, and so on and so forth. So there was at the margin this which played as well. So what did equities do? You had the US market, which ended down. S&P was down 3%. Nasdaq was down 3.4%. But the point is, from the lows, there was a sharp recovery. And that's the next graphic. So S&P bounced 1.3% from the lows, and the Nasdaq recovered 3% from the intraday lows as well. You had the CBOE Wix, which closed last Friday at 23. Pre-market US, it had jumped to 65. It finally fell and closed at about 38. So 23 on Friday, 38 as of yesterday's close as far as the US is concerned. Bond yields ended absolutely flat. The 10-year lost 1 basis point, so no incremental pressure there. We left off at about 3.78% last night. Now, you know, the point with regards to the US session that I want to make is, you know, yesterday in Asia, it looked traumatic. It looked uncontrolled, unhinged, right? I mean, the way markets were selling off, circuit limits were being hit, etc. By the time it got to the US session last night, it was much more orderly. I mean, if you read global stuff, a lot of people are talking about it being a more two-way market. There were lots of sell orders, but there were a lot of bids as well out there in the market. Even though the S&P ended 3% lower, the Nasdaq ended 3.5% lower. It was a more two-way market. It was more orderly. There were exits, but it was orderly. And I think that is important to note. Now, the other talking point, of course, yesterday was the yen. And yen did not sort of break levels. It hit about 142. And then it paired gains to 144. So it depreciated. The yen depreciated against the dollar to about 144 by the time things ended in the US. And this morning, Nikkei is seeing a sharp rally. I mean, it's basically recouping almost all of yesterday's 12.5% losses. And we'll talk more about that. That's, of course, a live market, so we'll have to look at rates as we come along. I think, and it may be a sort of, it perhaps is early. It is early because we've just had 1 or 2 days of panic, but maybe the bulk of the panic is done with what we've seen last night in the US and the way the market sold off in the US. The panic is done. I mean, you know, hedges and hedge funds, etc., would be out. Large financial institutions who had to forcibly unwind would be out. Retail is a different matter, especially with Japanese money, etc. But I think for once, for the time being, that panic kind of situation perhaps may be behind us for global markets. Now, just to circle back to the levels, it would be great if the Nifty defends yesterday's lows, which is 23,894. It's the nearest level. Strong support below that at 23,628. What is that? It is the 38.2% retracement of the rally from the lows of the election low, which is the 4th of June, to the recent high, which is 25,000 plus. That number is 23,628. And watch for a positive daily close, which should give us the first indication that maybe we are getting past this. Unlike the Nifty, Bank Nifty yesterday already retraced 50% of the rally from the election lows. So it's a much more weaker setup there. On the way down, 49,718 will be an important support. And below that, the Nifty Bank will see support coming in only at the 61.8% retracement, which is 48,858. GIFT Nifty comes up on your screen. It should give you an indication of the start. 200 points higher, right at the word go. I'm not expecting a huge V-shaped one-way kind of a rally, but the point is maybe it's more stock-specific, more discerning. Everything got ignored with the global sell-off, and I think it's maybe time to get back into stock-specific opportunities and situations and look at it as a more normal market without all the panic we've seen over the last 48 hours. Sonia.
Oh, absolutely, and there was a lot of panic, right? So it's really a relief to see this 190-point up move on the Nifty. But you can't rule out volatility in this market. At least that's one thing. Remember, the India VIX had a huge spike up. It's at a 1-month high. So some more volatility is something that you can perhaps expect. Let's also tell you what happened overnight, right? I mean, the Dow was under a lot of pressure, so no two ways about that. The Dow was down about 1,000 points in trade, and there was large selling by foreign investors in our own market. So if you look at it, FII sold 10,000 crores in the cash markets yesterday. The good part in all of this is that crude prices have fallen. So NYMEX is at a 6-month low now on the back of recessionary fears, and falling crude prices is always good for a market like India. So keep that in mind. This morning, a lot of the Asian markets have opened with big gains, right? So the Nikkei market is up 10%. It's regained all of its losses. The US futures have recovered as well. So there are some important questions that I'm asking. One is that will the dips get bought? In all likelihood, it will, given that there is some green on the screen. So perhaps you should go out there, get your shopping basket ready and look for opportunities that maybe you didn't get a chance to invest into when this market was, rallying. Also, is this the first real correction in a longer bull market, which means that could this correction extend further? If it does extend further, then perhaps the best thing to do would be to wait and watch. These are a couple of, questions that need to get answered. But for now, there is a big rebound in the Asian markets. Remember, there were historic losses yesterday. The Nikkei is up 10% now. And let's not forget that give and take everything, right? The Nifty has given you a 12-13% compounded return over the last 15 years, despite a pandemic, despite a war, despite a financial crisis. So just keep that in mind when you look at steep losses, and perhaps there's no need for any kind of panic.
Well, that's right. Let's look at the trade setup then. And there are signs that the global markets, they are stabilizing, at least this morning itself. You have the Asian markets that are trading in the green, and the CBOE volatility index. It ended much higher in yesterday's trading session in the United States, but it came off close to around 40% from the peak of the day. So that's good news. The Indian markets, well, they've been outperformers. I say that because the Indian markets, well, we've corrected close to around 4% from the peak. But you have markets like the Kospi that's down close to around 8%. And you have the other Japanese markets and the likes, the Nasdaq, that's down more than 10 to around 15%. So that's why India has been outperforming. And I expect the Indian markets to continue to outperform from here on. In terms of the domestic queue, you'll have the Nifty Financial Services Index that will play out to weekly expiry as well. But let's get to the other data points. The FIs, well, in yesterday's trading session, the long position, the net long positioning has come down to around 1.1 lakh contracts because they unbound some long positions and they added short positions as well. So from close to around 1.5 lakh contracts, that's down to around 1.1 lakh contracts. The client positioning, well, there has been some covering of shorts. Remember the client short positions had moved to around 87,000 odd. Well, that's gradually come down lower. So there are signs of short covering from the clients as the markets have seen a bit of a dip. In Friday's trading session, we ended lower. Even in Monday's trading session, we ended lower. And that's calling for some short covering from the client's positioning. I'll view this positively because they have been getting the direction of the market right. Yesterday, it was a weak session. So the call writers, they came back into play. And because of the kind of call writing that we saw, we did see the PCR come down to the lower end of the range. Remember, at around 0.65, 0.7, normally you see the Nifty see a bit of a bounce back. And the reason we came down to this level is because yesterday the 24,500, 24,400, 24,300 call, all of them, they did see a fair bit of writing. Now this 24,200 call, well, these call writers will get a little bit nervous because the GIFT Nifty is suggesting a gap up and those writers could be in trouble. So we'll have to keep an eye on this strike, whether we see some unwinding at this particular strike. Moving to the levels then, well, the Nifty, we're seeing a bit of a bounce today, but you'll say that, a fresh breakout will come about only once we get to the 20 DMA, which is quite a distance away from where we are currently. Support levels, 23,800 is rather important. The 50 DMA as well comes in around there. And yesterday as well, we went to close to that level. So that's the important mark on the downside. The 100 DMA, well, if that 23,800 breaks, then we'll see a further downtick. Since today's the Nifty Financial Services Index expiry, let's look at a couple of strikes. Well, we had the 23,000 call that had a fair bit of open interest built up. The premium ended at around 29, but at some point of time, it was close to around 150 to 200 odd. So the crucial resistance level on the Nifty Financial Services Index is 23,200. The start's in the green. We need to build on from there and take out those crucial levels.
Okay, thanks a lot for that. So lots to watch out for as we begin a brand new day of trade. And thankfully, as we've been telling you, there is some relief that we're looking at this morning, especially across most, global markets. But on the equities front, we have first up a comment coming in from Mahesh Nandurkar of Jefferies, who says that the higher risk of a US downturn now factors in a 132 basis points Fed rate cut by December 2024. The consequent US dollar weakening should augur well for Indian stocks on a relative basis. But on an absolute basis, the risk is on the downside, given one of the longest streaks of the bull run, unsustainably high domestic retail flows and potential capital gains tax hikes in the future. They maintain a defensive stance and their preferred large-cap laggards are private lenders, staples, L&T and two-wheelers.
Okay, this is another interesting view. This is Victor Schwetz of Macquarie, who says that given the sell-off in Asia and the spike in wicks above 50, the question is what dangers are investors facing? Does it require joining the stampede or create a buying opportunity? Victor says the sell-off was precipitated by a confluence of events. That is, perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, third, potentially disruptive unwind of the yen carry trade, and authoritarian regimes view such volatility as evidence of fragility of the West, potentially encouraging geopolitical adventurism. Although stampedes are inherently unpredictable, they are viewing this as closer to irrational, thus creating buying rather than selling opportunities.
Okay, and let's also get you some money market views because the rupee has been hitting new lows as well. Abhishek Goenka of India Forex and Asset Management says the rupee has underperformed amidst broad dollar weakness. While until last week it was the best performing Asian currency, it has slid into the middle of the pack with the ringgit, Singapore dollar and offshore Chinese yuan overtaking it. With high carry and low volatility was the beneficiary of carry flows. Hence, he expects the rupee to continue to underperform amidst risk aversion, but does not see a runaway depreciation. In the medium term, the rupee is expected to trade in a range of 83.40 to 84.40.
On bonds, Vishal Goenka of India Bonds says that extreme and violent price moves mark trading across assets in global markets in the past few trading sessions. What started with Bank of Japan's move last week quickly transformed into yen currency unwinds, resulting in shock asset price moves across bonds, equities, forex, and spikes in volatility all across. India remained fairly insulated so far, and he expects the RBI to stay on hold and vigilant at their policy announcement due on Thursday. He expects bonds to face resistance this morning with a bounce in Japanese equities and the 10-year benchmark bond yield to trade between 6.86 to 6.92%. Also anticipates global volatility to continue this week as well.